It makes me wonder, Alessio, we'll begin with you, whether Bill Gross is right. That the party is over, right? And not just in Europe, but everywhere, risk asset prices are going to drop this year.
I could agree with part of that view, but let me qualify where I would disagree. Where I agree is that all these low interest rates and QE doesn't really do anything to resuscitate growth if you do not have fiscal stimulus. The reason being, because you are in a balance sheet recession in the private sector, both corporations and consumers, especially in Europe, are not in a mode to take on debt. Sometimes they can't even. And so in an economy, things have to adapt. If two major agents of the economy, if the private sector is saving, somebody else has to spend to sustain the economy. And if that's not the government through fiscal spending, you're going to go into a deflationary trap. Surprise, that's exactly where we are after 4 years of these policies of austerity in the Eurozone, right? You go through austerity, you achieve primary surpluses, but GDP collapses. Debt to GDP ratios are higher today than they were before all these sacrifices were made. So we know in Italy, Renzi has been pushing with Merkel for a little bit of leeway on these austerity policies, of a targeted fiscal plan, fiscal spending plan. And I think the vote in Greece is exactly about that. Syriza is getting some support because they want to talk about renegotiating these austerity measures.
So, Simon, is what Alessio is saying beginning to, I guess, become the prevailing view in Europe, that while Draghi talks about the need for further monetary stimulus at the ECB, it may accomplish next to nothing because yields on the bonds that the ECB presumably would be buying are already well under 2% and in some cases near zero?
Yeah, absolutely. The bang for the buck that Mario Draghi's QE program, if he indeed executes one, is undermined by the fact that bond yields are so much lower. They're much lower than where yields were in the UK and the US when those central banks started to buy bonds. And so, yeah, certainly the impact from buying in Europe is already diminished by the fact that yields have fallen so low. The ability to get them much lower is greatly reduced.
So if the ECB were to engage in quantitative easing, and it appears as though it will, what's the net result going to be? Where's that money going to end up?
Out of the Eurozone.
Right there, out of the Eurozone.
So here's the idea. Let's not forget, Draghi, at the last Jackson Hole speech in August, he specifically said, we can accomplish some, but we need reforms and fiscal stimulus. So Draghi is on board. The ECB knows that without fiscal spending, the impact of QE on growth will be limited. So as of now, where is that money going to go? Well, the Eurozone has a massive current account surplus that has been growing because of shrinking domestic demand. What that means? Capital account outflows. What that means, and we're seeing it in the balance of payments, equity outflows, fixed income outflows. So local Europeans have enough buying power to buy local fixed income, but there is excess savings that is leaking out of the Eurozone and going where? Everywhere. Europeans love fixed income assets much more than equities. The asset allocation of European private investors is on average about 80% fixed income.
Why is that?
20%. Institutional preferences, institutional regulations. But if you look globally, the biggest equity players in the world is U.S. investors. Japanese and Europeans are much more tilted towards spread product. They have a lower risk appetite, lower propensity to take on risk. So where is that money going? U.S. Treasuries. Where is that money going? U.S. Treasuries with dollar exposure. The dollar is rallying, the euro is falling. Treasury yields are falling and retesting 2%, falling below 2%, despite U.S. growth having accelerated over the last 6 months. They're going to Japan. They're going everywhere. That's why also emerging market yields, while underperforming developed markets, but they are still very well contained. I mean, the fact that Italy can borrow at 2%, at the same levels of the United States, it tells you about there is no shortage of appetite for fixed income securities. That's why QE in and of itself is not needed to lower yields. Yields are already going low by themselves. Where is that money going to go? That's the big question. I think more credit, more spread products, anything with a yield, anything with duration will continue to be very well supported.
Simon, is there any chance that the ECB, as a result of what you've said and what Alessio has explained, will consider something other than quantitative easing? Does it have any options, or is Draghi now effectively Merkel's prisoner?
It has lots of options. Whether it executes them, I think Draghi at the last press conference before the holidays pointed out that apart from gold, there's very little that they wouldn't consider. I'd throw the euro in. I doubt they're going to, at this point, start intervening to weaken the euro. I think you'd see a full-scale currency war if that was the case. But there's corporate bonds, there's other products out there, but he seems he's very much over his skis now. The signs and the hints are that it will be sovereign debt he looks to buy, but perhaps only 500 billion worth of that. And he does want, as was pointed out, governments to assist him in structural reforms and fiscal spending. Whether you'll see that is another thing, though.
So, that being the case, Alessio, the euro trading right now at more or less $1.18, $1.19, where does it go?
I think, given how easily we broke through 120, the momentum seems very powerful, and momentum with very little volatility. So 110, 115 seem the easy psychological threshold.
Hold on, powerful in terms of doing what?
How the chart shows, the euro bearish trend has been very steady, powerful in the sense that it hasn't had any setbacks. It hasn't scared anybody out with big corrections. It looks very similar to the yen sell-off that we had a couple of years ago.
You know, one thing that I noticed yesterday, and I'm sorry we don't have a chart to illustrate it, but Simon knows what I'm talking about. The decline in the euro matches up, not quite perfectly, but very closely to the decline in Brent. Why are they so trading in such lockstep?
So there's two components. One is the traditional negative relationship between the dollar and oil, which we can debate. There's several channels, several strong channels. I think it's a legitimate relationship. But additionally, I think there is this QE component now, because with the Eurozone and Germany at zero inflation, this deflationary shock coming from oil is only going to exacerbate the deflationary pressure on the Eurozone and therefore strengthen the case that Draghi has always made about QE. So I think
that's the chart actually right now. I just want to pull it up.
I think that's a very powerful relationship, and if you were to scale it to relative axis, it would look even much more tight.
That's what I had seen yesterday.
Exactly. The relationship is almost intraday tick for tick. So Draghi and the Germans in particular are terrified about deflation. Draghi and paradoxically Greece, I think, now have it easy because Draghi and Greece can prove, look, austerity led us.
Wrong.
Yes. Now deflation is knocking at the doorstep of the Germans.
So the Simon can answer this question. How long, Simon, does it take for the Germans to wake up and realize that they're wrong, if in fact that's the case?
Well, they would take a different ground, maybe a higher moral ground, and argue
How often do you hear Germans say they're wrong?
That austerity
after the Second World War
has worked, and that any fruits that have been born, I think this was the phrase by the finance minister last week in Greece, are a result of the policies they pushed. And yet, at the same time, you're seeing inflation in Germany at a 5-year low. They can't contain. There is a limit to how much they like inflation to fall, and so perhaps now, more than last year, say the opposition to QE might not be as great as it once was.